2 hours into the trading day, it's time for Yahoo Finance's Market Minute. Stocks are lower overall, except for the Nasdaq holding above the flat line as traders are cautious ahead of trade talks between the U.S. and China coming this weekend. BP shares higher amid a Financial Times report that reveals a number of oil rivals like Shell, Chevron, and Exxon and others have run the numbers about a possible takeover. Grindr shares are falling as first quarter revenue misses the street's expectations, but some analysts are bullish, with Raymond James citing the stock's valuation, saying any pullback is a buying opportunity. Trade Desk shares are soaring after the company's second quarter outlook for adjusted EBITDA came in above expectations and first quarter results beat on the top and bottom line. That is your Yahoo Finance Market Minute for this morning. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, Portfolio Check-In. One portfolio manager describes why now is not the time to bet on specific market outcomes. And housing hurdles. We discuss why staging your home can make a difference for would-be buyers. Plus, savings strategies. We discuss how to capitalize on high interest rates after the Fed held the benchmark rate steady this week. We've got all that and much more coming up during today's show. But first, we take a look at some of the market action 90 minutes into the trading day. As we're taking a look at the Dow Jones Industrial Average as of right now, we're seeing that moving to the downside by about 0.2%. S&P 500 is flat, just barely to the downside. And then the Nasdaq Composite, you're seeing that flat, but barely to the upside here. Here to discuss some of the market activity that we've seen transpire over the course of this week, with a lens in how to manage your portfolio. We've got Invesco Portfolio Manager of Equities, Justin Livingood, joining us here on set. Thanks so much for taking the time here with us.
Thanks for having me.
Okay, so the particular market outcomes that we're monitoring, walk us how you are positioning right now with that in mind.
Sure. We're looking at the markets and the economy and saying, well, this is as wide a range of scenarios as I've seen probably in my 25-year career. I could see, a dramatic downturn depending on how tariffs in the economy and the Fed policy plays out over the next 6 to 9 months. I could see on the opposite side a market rally, a new market high if things break the right way with tariffs and in fact the Fed is more supportive. So in that environment, what we've done with our portfolios and advised our clients is to try to be as neutral as possible across sectors, across factors. This is not a time to make a bet on the market in terms of the direction, a market call per se. And that we feel that positioning allows us then to sort of put our best stocks forward and our best ideas forward, and those individual ideas outperform. We generate our best outperformance through stock selection, as opposed to trying to make a market call in what is an inherently and particularly volatile macro environment.
And so within that macro environment, of course, there's a lot of different forces taking place. And the main buckets that we've been monitoring is kind of tariffs, Fed, and then earnings season as well. Which do you think is taking the most priority right now as we're seeing the markets try to have something positive to rally around at this juncture?
Sure. I wish it was in the opposite order you just laid it out. Ideally, earnings would always lead, because earnings, I think, ultimately are what most important for equities. I don't feel at the moment that's totally been the case. I think tariffs are still taking too much mind share in the market, and we'll see how the next few weeks plays out. I'm happy that in the last month, we've had a little bit, since the initial announcements, of a relief rally as people have become more comfortable that the worst case scenario is where we started, not where we're headed. I think in the middle, though, Fed policy deserves some attention, and we just had, an update on Wednesday from the Fed, and Chairman Powell reminded us how important inflation is. I think one thing that does give me some pause thinking about the next, let's say, 6 months, is that the inflationary impact of tariffs is going to take a few more months to really start showing up in the data. And Powell said, look, inflation's our number one priority. And therefore, I find it a little concerning that the market thinks we're having perhaps 2 Fed cuts starting as soon as later this summer, when the inflation data is likely to be ticking higher here in the near term. I actually think we're more likely to see no Fed cuts for a while. I think the Fed stays on the sidelines until late this year, and that perhaps is a challenge for equities to chew through. So I think the Fed policy, that middle of the three items you listed, is the one that might be the bigger issue as we go through the summer.
And so as right now, there are some companies that have either been unable to reaffirm their guidance or just all out pulled their guidance. What does that set up for the expectations that investors should have going into the back half of the year and really banking on the delivery or reinitiation or affirmation of some of that outlook from companies who had already kind of reset expectations at the beginning of the year here?
Yeah, this was a really interesting earnings season. It's just concluding last night and today. So for the last 3 weeks, this has been, I think, a useful set of updates from companies where they have, for the most part, been able to identify their tariff exposure and then talk about ways they're going to mitigate it. Some have had to, as you suggest, lower guidance a little bit and reset expectations down. I actually don't think they did enough of that, though. Probably my biggest disappointment of earnings season is that while companies gave us for the first time their assessment of tariff risk, they didn't go one extra step and also reduce perhaps their revenue outlooks or other expectations for the potential of more of a soft economy. We just had 0% GDP growth in the first quarter. We've got probably a pretty muted outlook for the next couple of quarters in the economy. I don't think a lot of management teams are fully baking that scenario into their guidance. They just stopped with, hey, what are our tariff exposures? Let's go ahead and assess those, disclose those, reset accordingly, and then we'll hope that the top line, the revenue, the outlooks hang in there and that the economy doesn't get a lot worse. So I don't feel we have quite as much cushion in S&P earnings and revenue outlooks for the next couple, 3 quarters as we might need. And so that, coupled with the fact that the Fed perhaps is going to be a little slower to cut for those inflationary reasons I said a moment ago, gives me a little pause about the near term. 5,700 on the S&P is a pretty healthy spot to have rebounded to with those couple of things sitting in front of us.
We are still waiting for, of course, the AI poster child of them all, which is NVIDIA, to report. How do you think that can influence investors' trading thesis as we get into what essentially, May is always known as the sell and may go away type of month. But if we have NVIDIA come out and set the tone to say, hey, we're still seeing businesses purchase, we're still seeing an opportunity for us internationally, what does that set the tone for the rest of the markets and some of the top trading theses around the AI trade as well?
Yeah. It's been interesting this year, and really going back into last year, technology as a sector has not led like it did, in 23 and parts of 24, including NVIDIA. And so expectations have come down for the semiconductor group, I think also for NVIDIA, as has valuations, by the way. So I think there's a little less downside risk that if NVIDIA's outlook isn't super robust, that's going to have as much impact on the market as it used to. I think tariffs and even Fed policy maybe have jumped the line a bit in terms of what the market's going to react to. So you're right. We'll see NVIDIA's update. I have, I don't have a strong view on what they're likely to say.
Sure.
But I am less concerned than I might have been in prior quarters that if there isn't a perfect update from Jensen and the management team at NVIDIA, that there's going to be some downside risk to the markets. I'm still more concerned about, again, Fed outlook and sort of earnings for the broader S&P 500 as we get deeper into this year in relation to where the economy might head.
Justin Livingood, who is the Invesco Senior Portfolio Manager. Great to have you here in studio with us today.
Appreciate it.
Now time for some of today's trending tickers. We're watching CrowdStrike and Tapestry, and joining me now, we've got Market Domination co-host Julie Hyman here on set with us. First up, we got to talk U.S. prosecutors and regulators reportedly investigating what senior executives at CrowdStrike may have known about a $32 million deal with IT solutions provider Carasoft Technology Group. Additionally, 2 other CrowdStrike transactions here are being examined according to Bloomberg. CrowdStrike shares on this, Julie, down by about 4.2%.
Yeah, they were down by more earlier, actually. So this is a little bit complicated because it is reporting by Bloomberg, who are citing people familiar with the situation. And it seems to have to do with the practice of pre-booking, where they sort of count this under the bookings column before the deal is actually signed on the dotted line, so to speak. So basically what's happening here is The Department of Justice and the SEC, according to Bloomberg, are investigating this deal for $32 million to supply cybersecurity software to the IRS. So it was CrowdStrike via Carahsoft here. And the IRS apparently never purchased or actually received the products. Both Carahsoft and CrowdStrike have said they stand by the transaction. In fact, a spokesperson for CrowdStrike saying to Bloomberg in a statement, as we have stated previously, we stand by the accounting of this transaction. So part of it seems to have to do with accounting standards and how these things are booked here. This was back in 2023, by the way, that this deal happened. Yeah. So this is sort of looking back and trying to figure out how these deals are accounted for.
Especially when a lot of companies in similar kind of ERP or some of the larger resource planning software capacities would generally talk about that as pipeline opportunities that they see or active deals instead of kind of putting it on the books outright. So that is something that is interesting. We'll see how that continues to develop.
Yeah, like I said, a little complicated. Yes.
Also, we're tracking something a little less complicated, perhaps for some of the weekend shoppers out there. Tapestry, they've got an upgrade to overweight from equal weight over at Morgan Stanley, and the firm says some concerns they previously held have improved. They think earnings will be better than expected, and they think the company is handling tariff uncertainty well. Shares of Tapestry, fractionally higher here on the day by about 0.7%.
Well, they got a boost earlier in the week because just to take a step back, Tapestry reported its numbers this week. It's the owner of Kate Spade. It's the owner of Stuart Weitzman, which it's spinning off, selling, and it is the owner of Coach is the other one that it owns here. So the company reported earlier in the week, they raised their outlook. They said they're not that exposed to tariffs. They don't get that many of their products from China, and it seems like demand is holding up pretty well. So that seems to be what was the impetus for this upgrade to overweight here. And basically, the folks at Morgan Stanley thinks the street is underestimating what this company can earn, in part because the company is seeing improved gross margins in some of its various brands. They actually say once the Stuart Weitzman sale happens that margins will improve because that is a lower margin business than the other two brands here. And they also like that tariff resilient that the company talked about because of its low China sourcing. It's got high international revenue mix. So, you know, even if it's affected by tariffs, it sells a lot of stuff abroad. So that stuff is not tariffed in the same way. So kind of interesting and counterintuitive, right, to what you would think for a high-end retailer. And the shares are actually up this year about 20%.
It was interesting what they put in the note, saying that there's a long road from here on Kate Spade, and we're still skeptical of multi-brand portfolios, which was the entire reason that they rebranded as Tapestry, bringing all of these brands under one fold and saying, what should that new name be? And then they came up with Tapestry, and we were like, all right, well, I guess we'll rock with that for now. And now to see some of the strategic moves that they're making, unwinding at least parts of that business to see where there's a potential deal and potentially some capital that could be infused into the business.
I mean, hey, it's Tapestry. Could be worse, could be Versant. Sorry for the shade, Versant, but at least it's Tapestry's a real word, is what I'm saying. I like, you understand what Tapestry means and what it's going for.
We can envision it. We can see it.
Yes.
We have experience with it.
Right.
Julie, thanks so much. Appreciate it. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Recent market weakness spurred on by uncertainties surrounding President Trump's trade policies has prompted a surge in stock buying from retail investors. Here to explain, we've got my Morning Brief co-host, Madison Mills. Maddie, what do we know?
That's right, Brad. Well, Bank of America says its retail clients are on a record-breaking buying spree, snapping up stocks for 21 straight weeks. That is the longest streak since the firm started tracking the data back in 2008. And despite a volatile start to 2025 and concerns about President Trump's renewed tariff threats, individual investors have been pouring money into U.S. equities, buying both ETFs and individual stocks. In fact, 8 of 11 S&P 500 sectors have seen net inflows from this group, retail investors, year to date. It's a clear sign that Main Street's staying bullish, even as Wall Street grows more cautious. Bank of America's Michael Hartnett this morning telling clients to buy the expectation and sell the fact, a fancy way of saying buy the rumor and sell the news. And then Peter Cheer telling me this morning on set that he continues to advise clients to sell the rally as trade uncertainty remains in place. If institutional investors continue to sell any rally, it may be hard for retail investors to hold on to any market momentum to the upside for too long. Brad?
Maddie, thanks so much for breaking that down. Coming up on the other side of this short break, is a college degree right for you or your child? We'll take a look at the opportunities beyond a four-year university. That's next on Well.
Are college degrees necessary for all professions today? And I don't think so. I think there are some. Clearly, you want to be a doctor, a lawyer, an engineer, you've got to go and you've got to put in the time. But I do believe more now in skill-based learning. I think that students in middle schools and high schools who go to college because maybe their parents said, well, you really need to go to college in order to make a good living, or whatever, and yet they don't have to. They can do other kind of schooling, get right into the workforce, and I think that's an important cultural rethink that we should have relative to education.
That was U.S. Education Secretary Linda McMahon talking to Yahoo Finance Executive Editor Brian Sozzi at the Global Milken Conference. Our next guest is in agreement with McMahon about pushing for alternatives to a college education for some young adults. Here with more is Randi Weingarten, who is the president of the American Federation of Teachers. Randi, you wrote an essay for the New York Times titled, "Stop Trying to Make Everyone Go to College." And even though you don't agree with Secretary McMahon on a number of other issues, you seem to have found some common ground here. Explain what you're advocating for.
So, so part of what we're advocating for is based upon, being in schools all the time and seeing what works and doesn't work with young people. And what we're seeing, let me do it from the education side first, not from the workforce development side. On the education side, what really works for young people is if we create welcoming and safe environments that are engaging and relevant to kids. And career tech ed, the modern day career tech ed, which we have really fought for since, basically the middle of the last decade. What we're seeing in statistics is that when kids graduate in pre-apprenticeship programs or industry stackable credentials from high school with a credential in cybersecurity or in advanced manufacturing or in nursing or in culinary or in some of the trades, there's a 95% graduation rate and 70% of those kids go on to college. And as the Wall Street Journal just saw this week as well, kids can get pre-apprenticeship or direct jobs for $70,000, $80,000 right after high school. And then meanwhile, 40% of kids who graduate from high school don't go to college anyway. And 60% of kids and only 60% of kids that do go to college actually graduate from college within 8 years. So what we're saying is let's open up the aperture. Let's have a high school be a gateway to both college and career. And we now know we can do dual credentialing for, to have AP courses for kids in 11th and 12th grade. Let's do the same thing for the kind of careers that you can get credentials for as well. And that's what we're saying. And we're seeing it working, and it's working for kids. Now, at the same time, what also is happening is the workforce really needs it. So, for example, we're working with Micron in New York in 10 different school districts to create a pathway to advanced manufacturing in microchips. We're doing the same thing with Bloomberg Industries in healthcare. So why not make these, excuse my language, pilots around the country, but why don't we actually do this for all kids so that all kids can make these decisions themselves and create that kind of real robust choice within public high schools.
Okay, a couple of things that I want to break down. Certainly. A couple of things I want to break down further here because at the root of it, it comes back to how much families are paying for the cost of college and what the return on that investment is later on, especially if we're seeing a skyrocketing in the costs, but the wages are not keeping pace with those costs as well. What is your assessment there?
So look, at the same time, and this is where, Linda McMahon knows that we have cared about this. Look, I started my teaching as in a career tech ed school in the 1990s. We fought to keep it open, and I taught AP Gov in a career tech ed school. So that kind of busts through every stereotype you can bust through. I think that the issue is the affordability. College is an issue, but it's more than the affordability. It's that some kids actually you have to meet kids where they are, and you have to meet their want and aspirations and create a whole bunch of different career paths for them. So the cost of college is one issue, but I think it's rooted even more deeply than that. You know, some kids, like there's a kid in New Lexington, Ohio, who I mentioned in the op-ed Chase. You know, he really wants to open an electrical business, and he's on his way from high school on to become a journeyman apprentice, an electrician. And those are really good jobs, and they require really important skills. So why not expose that from a young, when a youngster is really thinking about the pathways.
Certainly.
So yes, affordability is an issue, but I think it's more than affordability. It's about really thinking about choices for kids.
Randi, and kind of clicking further into that, you know, as we're thinking about what the Secretary of Education, Linda McMahon, has also been talking about in shutting down the Department of Education, likely so that there could probably be some type of privatization that takes place. Would that also then facilitate what we're talking about in having companies also have more of a line of sight into where there are, in education systems, the ability to then equip the next generations and future generations for specific industry, for specific sectors, and how we can identify those talents earlier on? What's your assessment?
First off, it would be the opposite. I mean, we've had these, you know, in the past, in past, not only administrations, but eras. Like if you take the New York City subways, you see all these ads for trade schools. Many of them have closed down. They were terrible. The Obama administration actually started holding them accountable. They would say to kids, here, you know, give us tuition money and we will train you to be a welder. And and more times than not, they didn't. So the issue really is not the privatization. We need industry to be aligned with us and to work with us more. The issue is, how do we use a public school system to help all kids be prepared for their lives and careers? So what Linda McMahon is actually doing is making it harder. And the Career Tech Ed Association, High School Association, ACTE, basically said, don't make these cuts to, Perkins. I'm sorry, that's the name of the grant. The Perkins and the Career Tech Ed grants. We actually need that, and we need more alignment. We need to actually have in states the economic development people, the workforce people, and the schools people all work together. So there's one-stop shopping for business and industry, particularly small business. It shouldn't have to go to 3 or 4 separate places. And frankly, Gina Raimondo, when she was secretary in the Commerce Department, she saw this, and we worked more closely in the Biden administration with a Commerce secretary than we did with anybody else on these issues.
Randi, good to have you here with us today. Thanks so much for taking the time. I know we had to reschedule a couple times. Appreciate you joining us.
Thank you.
Coming up, shares of buy now, pay later firm Affirm are in the red after earnings. Find out why. Let's get a check on markets here as we are now 2 hours into the trading session, 90 minutes when we started the show. 2 hours into today's trading session. We're taking a look at the major averages here. Just a quick check in on the Dow. Has us down by about 0.25%, and that is actually a move lower from where we started off the day here. Just going to put a line chart on this. This is the past 6 months. Let's put this on an intraday view. We started off the day in positive territory. We've seen some slippage midway through the 10 a.m. hour here, and now we're fractionally in the red. The NASDAQ composite, about the same case there. You've seen a little bit of hyper waffling around that 11 a.m. hour, but ultimately, as of right now, we're to the downside by about 0.1%. The S&P 500, same case there, in the red by about 0.1%. Let's dive a little deeper in, see what's playing out on the sector activity. This is crypto, so let's get on over to those sectors. 11 S&P 500 sectors. Got them pulled up here from you on the screen, and taking a look at XLE, that is leading the pack. We're up by about 0.7% here on the day, but there's a lot of red that you're seeing here. It looks like there are about, we'll call that, well, things are moving around quite quite rapidly here. So ultimately more laggards than gainers, but of the 11 S&P 500 sectors bringing up the caboose, you've got industrials and technology, the worst of the decliners here on the day. Still though, only about 0.3% in declines here, kind of digging deeper into that tech play right now. The NASDAQ 100, the tech-heavy average here, and some of the major mega-cap tech stocks you're seeing here, mostly in the red. Tesla, though, that's catching a little bit of some action here on the day. That's up by about 4.5%. And Apple, that's holding on to its gains during the session here, though off of the session highs that we've been tracking for AAPL. Well, switching gears here, Affirm shares falling after the buy now, pay later firm reported quarterly results. They were overall positive with a beat on the top and bottom line and raised fourth quarter guidance. The midpoint of revenue though, and that revenue guidance did fall below the street's expectations. Some analysts say that the stock's move lower is not necessarily a cause for concern here. To dive into those results, we've got Dan Dolev, who is the Mizuho Americas analyst. Dan, we've had you on plenty of times before. As we're kind of taking a look at what's taking place with the firm, I just want to get your own analysis here with Affirm.
Yeah, I mean, look, I think what's happening today is just an expectations management problem more than any other problem. So there's some like third-party data that tracks credit card receipts, and they were telling investors that the results are going to be like X, and I think that might have fallen short of that expectation. But it's really they beat their guide. They upped the guide. In this environment, upping the guide is like a really strong sign, right? They're telling you that even in a recession, they're not going to do as badly as people think. And by the way, we've done some proprietary work that shows you that the lower rates that come with a recession can more than offset the decline in volume from tightening the credit box. So taken together, all of this stuff, I mean, I think it's a huge buying opportunity right here.
And so with this in mind, as we're taking a look at the full year forecast here on the screen, what are some of the keys for this company, especially knowing that the core customer that they're going after is one that's perhaps looking at opportunities to kind of offset some of those large purchases or space them out in an environment where they might feel a little bit more pressured about some of those discretionary dollars?
So it's a great question. They're getting into more partnerships, right? Like the one with Costco, for example. They're going internationally, right? They're going into Europe. They're in the UK right now. So they're taking share away from Klarna. We've proven that before. So that's like a big thing, right? They're basically crushing them. So they're taking measures that should more than offset sort of the single, call it same store sales or same customer sales if their core customer doesn't consume as much over time. So it's idiosyncratic success story, and that's what we really like about Affirm.
And so as you assess Affirm versus the rest of the environment right now, is this one of the top plays for any investor that wants some type of exposure to a consumer that, is feeling that pressure, is looking for opportunities, and is shopping at some of the major outlets or places, retail partners that Affirm has just rolled out some of these announcements with?
Exactly, because they do have, like, for example, those 0% loans that they're 0% APR loans that they're offering. Those are really attractive for consumers and the merchants because the merchants can play with pricing without, and so they can convert more, right? So the thing is, like, if you just swipe your credit card, if you don't have money and you don't have credit, then you're not going to purchase something. But with buy now, pay later done smart, like Affirm, you can maybe afford to buy something and the merchant can afford to sell it, maybe giving a little bit of a merchant discount rate to Affirm, but then converting and selling the product. So it's actually a great way to play a company that I wouldn't say it's completely acyclical, but it's got a lot of counter-cyclical measures embedded into it, even in this environment.
As you kind of assess the broader fintech landscape here right now, it seems like there have been a lot of announcements coming forward, whether that be on the front of what they're doing to incorporate more crypto opportunities, which I know you and I have talked about in the past, or whether they are just trying to make sure that they are building out a platform that seems a little bit more all-encompassing and kind of having the fintech features without necessarily saying that they're an all-out bank. And so how are we seeing some of the fintech players kind of toe that line, and what is the consumer mindset around them kind of on aggregate right now?
I think the consumer is not as worried about it I think more from a definitional perspective, it's better not to be called a bank, right? Because it comes with a lot more regulatory pressure. So I think the consumer very simply, they care about, can they make a purchase? Can they be offered like direct deposits, right? Which is what the firm does. So can you put some of your paychecks there? So the consumer doesn't care about the actual definition. The consumer cares about functionality. And I think that some companies like Affirm, they give you this like functionality as a consumer that you can have sort of a super app that like a 360 super app that acts like a bank, but it's not really a bank.
Just quickly while we have you here, and I was just thinking about this a second ago after I came back from the market check a second ago. Bitcoin, which you and I have talked about, 100,000. What is the kind of milestone, not even just like the milestone of getting back to 100,000, but what does that signal to you about where we are in the risk appetite for investors?
It's a huge risk asset, right? I mean, it's the quintessential risk asset. I mean, that's what's been proven. It goes down when you have a risk-off trade. We are, our forecast, which we're using basically adoption curves, like we think it's going to get, like maybe like 20-30% higher by the end of the year. This is just based off of like adoption trends of consumers, whether or not you're bullish or bearish on Bitcoin. It's just the more people download those apps and buy it, the more it goes up. Simple as that. So it's a risk asset, and I think it's also like predicting some rate cuts. But I'm only basing my hypothesis on sort of those data points that we're getting in terms of downloads of Bitcoin related apps.
Certainly. Dan, thanks so much for entertaining the question there on Bitcoin as well as the analysis on Affirm here. Good to see you.
Good to see you.
Coming up, why staging your home could make a major difference with would-be buyers. We'll discuss next. If you're looking to sell your home, how you stage it could impact and how you have a big impact on how fast you can get an offer. More than half of buyers' agents say that home staging had an effect on buyers' view of the home, according to a report from the National Association of Realtors. Here with the details, Jessica Lautz, National Association of Realtors Deputy Chief Economist and Vice President of Research. Great to have you here with us. Why is staging so important?
Well, it helps a buyer actually walk into a home, visualize a home. They're scrolling through a lot of photos and they want to make sure that that home really clicks with them. And that could actually get them off the fence and into that home.
And so what is the kind of monetary impact here of staging? How much more can your home sell for ultimately if you make an effort to stage it?
Well, buyers and sellers agents are in agreement. We actually surveyed them separately to make sure that we were getting an accurate measure on this. And what they both said is it could actually increase the offer by 1 to 5%. So that's actually a really good return on value for home staging, which could be much lower than that.
So when it comes to staging, your report found some rooms had more of an impact than others. So what are the rooms that should be prioritized here?
Well, it's the rooms that have the biggest impact on where you're going to live. So thinking about the living room, the kitchen, the primary bedroom, that's where people spend the most time and really probably where they want to visualize, okay, how is this going to be when I'm cooking a holiday meal or helping my kids with my homework? How am I going to relax in the evening? And that's really where people want to visualize walking into that home.
Your report also touched on the importance of home repairs before listing a home. What are some of the most common improvements that you see sellers make before putting their home up for sale?
Well, a deep clean, obviously, curb appeal means a lot. Painting the home, doing a refresh, all of the things that really could be an eyesore before you walk into that home, you want to make sure to tackle them. Even removing the pets before showing can really make a difference there to home buyers as they walk into that home.
When do you know not to take a project on? If it'll cost too much, if there's just not the return on investment versus the impression that you're trying to make in order to get the sale done?
Well, certainly. I mean, you probably don't want to tackle a big kitchen remodel before you put that home in the market, but perhaps that leaky faucet is something that you might want to tackle. So really thinking about the return on value of how much that costs, but your local realtor is going to be the one who's going to be able to tell you at your price point what makes sense to tackle within this home.
Are we seeing any impact from tariffs? Tariffs making some of the small projects just a little bit more expensive, and then that factoring into if a seller is kind of willing to take on or start that project?
Well, yet to be seen at this point. What we have seen is more inventory coming into the market. So we know with more inventory, that means that people are tackling these projects in different ways. Could it cost more? It's possible, but I'm sure that there's ways around that too, creatively.
And certainly as we think through whether it's something that you say, all right, you know what, I'll just do this project myself, versus have a contractor, have someone who is a vocational expert come in and do that project. When do you know to pass it off to the person who is the pro?
Well, I think that's probably going to be an internal decision. If you don't know how to tackle that project, you probably shouldn't be doing it before you put your home up for sale. Certainly, call the experts when you are in need. There's a lot of DIY that obviously goes around. If you feel comfortable doing it, if you feel comfortable taking out that paintbrush, but perhaps not the electrical wiring if you've never done that before. I know that YouTube gets a lot of people out of trouble, but maybe that's not the be-all end-all.
I mean, do you even know, Jessica, how many kind of handy videos that I have saved on Instagram right now, just of people doing simple things around that? I don't even own a home right now, but I'm trying to make sure that I've got all of them saved for just later on in life when...
You are prepared. I love it.
I'm trying. Jessica, good to see you.
Good to see you too.
Credit card interest rates will likely remain unchanged in the wake of the Fed's decision to hold interest rates steady. However, you can avoid paying credit card interest for up to 21 months if you choose the best zero APR or the best balance transfer credit card for you. Yahoo Finance reporter Madison Mills has the details.
Here's how to find the best credit card for a balance transfer. You can move your credit card debt from one card to another with a balance transfer card. The advantage here, no interest for a period of time. That means you may be able to pay down credit card debt, consolidate balances from several cards, or finance a large purchase without paying interest. The best balance transfer credit card will offer you 3 features: a long interest-free or zero APR period, year or more is ideal, no annual fee, and a low transfer fee or maybe no fee at all. First things first, look for the longest interest-free period for new purchases and balance transfers. For most issuers, that is typically from 6 to 21 months. And remember, once that period ends, these cards carry high interest rates on balances, just like a lot of other credit cards. Next, check the transfer period. Some cards put a time limit on interest-free transfers. You may have 60 or 120 days from when you get the card to make that transfer. This next one is important. Check the fees. Many top balance transfer cards don't have annual fees, but it's always worth reading the fine print. And here's another reason that's a good idea. Balance transfer cards can charge a fee to move your balance over from another card. They're usually a percentage, often 3 to 5% of the transfer amount, usually within a $5 minimum. Keep in mind, to be approved for a balance transfer card, you're going to need a credit score that's considered good to excellent, typically 700 or higher. And one last thing, be sure to check the financial institution that's issuing the card. Generally, you won't be able to transfer balances from one card to another from the same issuer. And scan the QR code for more information on the best credit card for balance transfer.
Coming up, how you can use high interest rates to supercharge your savings. That's on the other side of this break. The Federal Reserve held rates steady at its May meeting as it aims to keep inflation under control. Earlier this year, 62% of consumers surveyed by Morning Consult said they feel rates are too high. I want to bring in Matt Scholes, who is the LendingTree Chief Consumer Finance Analyst, to talk through how consumers can use high rates to their benefit as part of our savings series brought to you by Synchrony. Matt, good to have you. How can savers take advantage of higher rates?
Well, the good news is that high rates, while they're really tough on people who are carrying debt, are really good for savers because it means that we're still going to see rates on online high-yield savings accounts remain really high. They're not as high as they were last year at this time since the Fed has cut rates. But if you shop around, you can still find these accounts that are giving 4% or sometimes significantly more back, and that can really ramp up your savings and really help people build important things like their emergency fund.
So how should potential home buyers navigate higher rates?
Well, the most important thing for people to know with home buying is that shopping around and comparing rates can make a huge difference. It can literally save you tens of thousands of dollars. And sites like ours at LendingTree and others where you can compare multiple rates from multiple lenders can allow you to save an awful lot of money.
So what's your advice for consumers with high interest rate debt?
Well, my advice is to control what you can control and to get those interest rates down as much as you can. So a 0% balance transfer credit card, for example, is about the best weapon that somebody can have in their arsenal against credit card debt, because it can give you a year, sometimes up to 21, 24 months without accruing any interest on that debt. And that can be a real lifesaver for people who are struggling.
So how can improving your credit score help you to save?
Improving your credit score is a really big deal. There's very little in life that is more expensive than having crummy credit, because it can end up leading to you spending thousands and thousands of dollars over the course of your life in the terms of higher interest rates, more fees, and just overall worse terms on loans that you get. So the more that you can do to improve your credit, the better off you'll be.
Matt, thanks so much for taking the time here with us today. I really appreciate it.
Anytime. Thank you.
Absolutely. Let's take a look here at the markets and some of the drivers behind it here as we're approaching the 12 noon hour. You're taking a look at some mixed activity on the tape. The Dow Jones Industrial Average right now is flat, just barely to the downside. You got the S&P 500 flat, but barely to the upside by about 0.1%. And then the NASDAQ composite, you are also seeing that flat, just barely to the upside here. I'm taking a look here at my screen on some of the sector activity that's transpiring over the course of today, and then maybe we could take a look at yields for a hot second. The sector activity that I'm seeing, as of right now, we're being led by energy and consumer discretionary, but consumer staples and communication services pulling up the caboose. And here's a look at yields. The 5-year, the 10-year, and the 30-year all moving lower here on the day. We've got some big tariff negotiation talks set to take place in Switzerland over the weekend. We'll see what transpires. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You could stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close. You don't want to miss it on this Friday.